Hello and welcome to another episode of the Investing with IWIBD podcast. It's Justin Nielsen, your host here, and Arusha Pierce, who normally joins me as my co-host, is actually out sick today. He's been doing a lot of traveling, and I guess it's caught up to him. But never fear, we've got a great special guest for you today. We're actually welcoming her back to the show, Katie Stockton. She is the founder of Fair Lead Strategies and also the portfolio manager for the ETF TAC. So great to have you back on the show, Katie. How you doing?
Great to be back with you, Justin.
Yeah, so I wasn't the host the first time around. You had Arusha, so I kind of feel like it's only fair that I get you all to myself this time. And then maybe
we'll have missed. We hope he gets well soon.
Yeah, maybe we'll have you back on, and then it can be a tag team effort. Let's talk a little bit. I mean, we have a lot to discuss. You know, the way the market's been, what we can maybe expect in terms of volatility. Going forward, what kinds of things that you're looking at and how you approach the market. A number of people probably recognize you from your CNBC appearances. And one of the things that I love about when you're on CNBC is that you bring in the technical information. I should mention that Katie, of course, is a chartered market technician. She's got those nice little CMT letters behind her name. So I'd love to kind of just throw up a NASDAQ chart right now and just kind of talk a little bit on the general market. I mean, here we are. Everyone was a little worried about the PPI, the CPI, these rate cuts that everyone was expecting, keep on getting pushed down further and further. And here we are now at new highs for the market after what was kind of a ugly cross of the 50-day and 10-week moving average line just a few weeks ago that looked pretty serious. But here we are back at highs. What do you think, Katie?
Yeah, I mean, it's more than a full recovery, right? We saw a pretty significant pullback in April and now new highs from the NASDAQ 100, from the S&P 500. So with that, we feel that the market is still exhibiting positive long-term momentum. Short-term momentum has been to the upside recently, but it did waver, of course, enough to affect what we call the weekly MACDs. Mm-hmm. Those are intermediate-term trend-following indicators that we use as technical analysts, and they still do suggest that there is risk of a greater corrective phase in the market. So we're not feeling like we're totally in the clear here with new highs having been logged. But what we'd like to see typically is when resistance levels like the ones that have been cleared are cleared, we want to make sure that breakouts are confirmed, especially when there's sort of emotional trading. We talked earlier about the volume as being quite high today, and sometimes that is reflective of an emotionally charged day. And so we sense that with the CPI data having hit this morning and obviously a big reception to that, we want to make sure that the market, the major indices can hold on to these pending breakouts for a few days before saying, okay, we're back off to the races here. We've been on board with this up wave, as we call it, the B wave of a corrective phase, which often unfolds in this kind of like ABC fashion, where the first wave is
so maybe talk a little bit about that. Yeah. What does that mean? Is this kind of, usually when people say waves, I think of Elliott wave theory. Is this along with Elliott wave, or maybe describe that a little bit?
It is, yeah. It's a derivation of Elliott wave. I myself am not a big follower of Elliott wave, but I do believe in the concept of corrective phases, both to the downside and to the upside, as unfolding in this kind of ABC fashion, which means that you have the initial down move, a reflex move, which is what we've been calling this one, and then another down move to finalize sort of the corrective phase. So we've been still, sort of mentally preparing for that C wave, but not actually preparing for it, really not until today. We talked about to our client base that the overbought conditions that have obviously affected the market of late have now sort of enhancement from something called the DeMark indicators. And these are tools that measure trend exhaustion. It's another one of our overbought, oversold metrics. And we do have a counter trend indication from those metrics. So we sense that the market's getting a little bit ahead of itself here. And you can see it in the S&P 500 index for one. So the DeMark indicators, which we use as part of our overall methodology, they have the ability to help us understand when a trend may be maturing. And so what we're looking for typically in these DeMark indicators are 13s. I see that you have my chart shared here, and you'll see that there's a 13 right now above the price bar, the current weekly price bar for the S&P 500. The last time we saw that,
weekly chart. This is a weekly chart that we're looking at.
This is a weekly bar chart, right? And so you see the numbers floating above the price bars. Well, those are the DeMark indicators, and they're automated, so it's not something I've drawn on the chart myself, but rather we're analyzing the chart based on these sort of price indications. And when you see these metrics reach these 13s, that's where we look for inflections. And you can see that the past 13s did indeed have inflections. One was very short term, one was actually quite long term ahead of the bear cycle in 2022. So it has us, I'd say, bracing potentially for a pullback. And it also has us, I'd say, a little bit skeptical as to the sustainability of this breakout. And what we're trying to do as technical analysts is really just put probabilities in our favor. We don't have any way to know where the S&P 500 is going to be in 3 weeks. But we can say, well, based on the indicators that we have a combination of an overbought condition, a counter trend indication from the DeMark indicators, and weakened intermediate term momentum. And taken together, that does increase risk that we have probably another pullback in store before this whole corrective phase is over.
So since we have this chart up, let's talk a bit about your other indicators that you have here. It looks like you have a stochastic on here, and you're getting the overbought indicator from that. What kind of time frame are you using on this stochastic?
I love this stochastic oscillator. So this is a slow stochastic for those that want to get real technical. And it's a 12 period with a 3 period smoothing effectively. And that 12 period is not something that I really chose myself. It was one of my mentors, one of my bosses who used it. So I by default had to use it, but then it just became part of my methodology.
Once you get used to it, it's hard to switch, right?
It is true. I'm definitely an old dog when it comes to some of these indicators, but we do like it in terms of the, I'd say, frequency of the crossovers and the responsiveness, I would say, to the short-term moves in the S&P 500 in this case. So we look at it in a bit of a nuanced fashion, in that we care about an overbought reading, but you can see just over the past few months that overbought readings can be sustained for a long time. So it's really when you see the down move in the stochastics that we react to that. And then, of course, we have the MACD indicator in the bottom window, and that's a very popular trend following gauge. It measures price momentum effectively, and it's based on exponential moving averages of price. So not to get too mathy on it, but it just is a way to kind of smooth out the moves and isolate trend shifts.
And to your point, one of the things I often say is one of the problems sometimes with overbought or oversold indicators is they can get more overbought or more oversold. And, so sometimes people, just the crossover by itself is not enough to go on. But as you said, it's kind of when the turn happens that I feel it's a little bit more indicative of kind of watch out, especially, you're showing 3 different things here: the DeMark, the stochastic oscillator, and the MACD, which, for those of you following at home who love your acronyms, stands for moving average convergence divergence. So, when you start having multiple indicators kind of saying watch out. And I should also just mention too, you said this, but I want to emphasize it. Let's say a pullback happens. It doesn't necessarily say how deep or how long or anything like that it's gonna be, or even when, because again, it could kind of have a little bit of time up here before that turn happens. So
yeah, that's for sure. So we don't have the crystal ball in these indicators, of course, but I find that they help us stay on the right side of a trend, and they help us understand if that trend is full force or losing momentum, maturing, or even at a turning point. So we find real value, especially in the binary nature of some of these indicators, where a MACD will either be on a buy signal or a sell signal based on its crossovers. And so, you can't argue against that. You can disagree with the bias that it infers, but you can't really argue against the math behind it. So it puts more odds in your favor in a way in your trading and investing. And you can use these same tools that you're looking at on the weekly bar chart across multiple time frames. And that's what we do in our work. We'll look at it on a monthly bar chart, we'll look at it on the weekly bar chart, and of course on the daily bar chart, even sometimes going and zooming in on the intraday charts. We're guilty of that too. So we find that this helps us a whole lot gain confidence in our positioning.
So let me ask you this. When you have some of your favorite indicators and you're looking at them, I've got two questions. So we'll take them one at a time. First of all, what happens when they give you conflicting signals? Number one. And in this case, when you have the signals kind of converging for you, what do you do with that information? Does that turn you a little bit defensive, or does it just make you brace yourself?
Well, yeah, so that is the art of technical analysis. So it's both a science and an art, really. And we find that, let's say, one indicator, if we were to just rely on the MACD, well, it would send us down the wrong path at times. So we can almost nuance it with the stochastics for one and say, well, if they're saying the same thing, that gives us more confidence. But if they're saying different things, we'll have less confidence in what that MACD is saying. So it's really kind of gradations, I would say, of confidence that we can get by combining these indicators. And unfortunately, it's not as simple that way, but it does add value because it's not a perfect market, right? We have ways to try to understand it through technical analysis, but it's the boss, right? It's going to tell us what it wants to do, and the indicators will just help us interpret that.
Yeah, and I should mention, that these indicators that you're talking about are really price based. I mean, it's very kind of cut and dry. CPI, PPI, interest rates, all of that, earnings, all of that just really doesn't matter. It just comes down to price, not even volume.
Well, if you think about it, the price, this is all price based, indeed. But the way I think about it is that all of the macro data, all of the fundamental data is absorbed and ends up filtering into a buy or sell decision or a do nothing decision, right? So most of that information is manifesting itself in supply and demand for the securities. A lot of people can't differentiate between a company and a stock, but indeed, a stock can be doing one thing that's completely out of line with what the company's prospects are. And I think that's where the technical analysis can really come in handy and help people understand that there's more than just that fundamental data that they need to make an informed decision. They need to take in, sentiment data, price data, macro data, political information, things of that nature.
Right. And, it's also worth mentioning that, for as much as the fundamental story and, how valuations are made, there might be, a lot of quantitative analysis behind it. But at the end of the day, we're human, right? So what I'd like to do now is I'd like to just quickly, throw up a chart here because, to your point about not necessarily needing to look at volume, the NASDAQ volume, we had kind of what we call a follow through day. And the follow through day is kind of our signal for an uptrend. But the reality is we kind of had these follow through days in spirit back here on April 26th, May 2nd, May 3rd, May 6th. Those were kind of the days that were the most important, but we didn't get volume heavier than the day before, which is what we look for. But as Mike Webster mentioned on our podcast a few weeks ago, we might have to take some of this volume with a grain of salt because you see these big spikes here that we got. And I'm just going to lay it out straight for you folks. That volume is dirty. Fair-day future, which is now trading at 73 cents because it's up 150% today. That accounted for 1.3 billion shares traded today. That's a huge amount when you consider that the NASDAQ is, composite is typically trading, around 7, 7 billion is what it was today. And that's a big day. We have to take some of that with a grain of salt. But, before we end kind of this, this discussion here on the market, I wanted to bring one more aspect here, Katie, and I'm going to share some charts again of yours that are with regards to the VIX. So tell me a little bit about what you're looking at in terms of the VIX for your market analysis.
Yeah, for sure. And just to your point on volume, I agree with Mike. I do think that it's lost some value in technical analysis. It used to be at the textbooks, you would read how important volume is to an expanding trend. You would ideally want to see it growing as the market would rally and things of that nature. But with the advent of so many different products, ETFs and derivatives and, the sort of creatives,
Right.
strategies and market structure, I just don't think it's quite as important as it was, but we do look at it in aggregate in the same way that you were, where if we do see a volume spike, a dollar volume spike on the exchanges, that can be indicative of an inflection, because it shows like that you've heard of buying and selling climaxes, right? They almost always have heavy volume on that singular day. So in a way, heavy volume, if indeed it was real volume, would suggest that we could be at a short-term peak, which is kind of interesting and somewhat counterintuitive in a way. Now, but looking at the VIX, I think it's really relevant. We're talking about it a lot in our work, and the VIX is a transactional gauge of market sentiment in our work, and it's to us showing some complacency. We don't always just assume if it's low, it's showing complacency, but you combine that with the meme stocks rallying very strongly. It has that sense to it that the market's not quite, it's getting overly bullish, right?
Mm-hmm.
So with the VIX, we saw a pretty good downdraft as the market recovered off of the April low. And that downdraft has brought it into long-term support. And you can see it on this monthly bar chart here. Now the VIX, I don't know if it's easy to see, maybe sort of hone in on the 9-month moving average that's pictured. You can see cycles, and the cycles tend to last about a year on average, maybe slightly longer. And we're at that point where just over a year in duration for what has been a low volatility cycle. And we sense, based on the indicators, which are similar to what you saw on the other chart there, that the volatility is likely to increase over the coming months based on these metrics. So we have an oversold upturn, and we also have a loss of long-term downside momentum that together would suggest that this low volatility cycle is actually something that might mature pretty soon. And of course, that would be with a successful test of that support level pictured.
Yeah. And it's funny you mentioned that, because of course there's a lot of things that we could point to that might increase volatility. I mean, we've got a presidential election coming. It's going to be kind of a hot topic button. I mean, we've got the war in Ukraine still going on, the everything in the Middle East with Israel and Gaza. There's stuff to point to, but a lot of times it seems like with these VIX spikes, you don't see it coming, right? I mean, COVID was this last spike. Before that, there was this what we used to call Volmageddon, when some of these volatility instruments just imploded early in 2018 after a huge. I mean, 2017 was such a low volatility year, and then 2018 comes around and boom, it was here's the volatility.
Right. That Q4 2018 move was pretty explosive, and I do feel like we can't predict that, right? But we can manage risk by preparing for it, right? And that's where we stand. So we haven't been recommending hedging strategies yet, but we feel that we're getting pretty close. Where we would start to recommend that and we anticipate this happening fairly soon, is when we see these upturns become more decisive in the VIX, and at the same time, the downturns unfolding in the major indices, like those stochastics rolling over.
Yeah, perfect. Well, we're going to take a break real quick, and when we come back, we're going to talk a little bit more about some of the ways in which you're looking at stocks. So stay tuned. We'll be right back. We're back with the Investing with IBD podcast. It's Justin Nielsen here, and my special guest this week is Katie Stockton from Fairlead Strategies. She's the founder there, and also a portfolio manager of the ETF TAC. So you've given us your backdrop of how you kind of look at the market, and I guess that kind of informs maybe how you're going to be choosing your stocks and what kind of strategies you're going to be using. But let's get into this a little bit more. So what what do you do with this information on the market, and how does it inform your stock decisions? Are you
Yeah,
using the
I mean,
same thing?
it's a very fair question. So we at Fairlead Strategies have a research business. So
Mhm.
we're providing research to, investors, and they're small investors all the way up to huge investors. So we found that people use research in different ways. Some are looking for ideas,
Mhm.
simply want technical ideas. And we're sort of prolific with those. Others want to use it more as like a risk management tool, and it certainly is that. And then still others will use it for more specific strategies like sector rotation, or they'll look for portfolio reviews, things to understand that are more specific or bespoke to them. So there's a lot of use cases, I'd say, for technical analysis. I always say, to folks that are just getting started, that it keep it simple. I mean, I know that's cliche, but it is indeed good advice. I say just take some of the real estate on your screen and
Mhm.
dedicate it to a chart, and throw in a couple indicators that seem to make sense to you, and just start to look at the charts as you're analyzing the markets, right? As you're thinking through it, a stock purchase, as an example. We have our own ETF, as you mentioned. It's the Fairlead Tactical Sector ETF, or TACK. And to that end, we developed a model, essentially a rules-based system, using the methodology that we imparted on the S&P 500 chart. So it's a matter of how you combine the indicators that you can have success, I think, with investing from technical analysis. And that's what we've done. We really believe that there's value to like a systematic approach, where if you come back to the same tools, the same metrics, that way you'll remove some of the biases that we all have as we think through different investments. So we believe in a systematic approach. We also believe in long-term investing. We
Mhm.
believe that sector rotation is a really great way to try to outperform. It's sort of lower hanging fruit from the market. If you look year over year, there's huge sector dispersions. So that's something we focus a lot on in our work, and also for our ETF. So there's a lot of use cases, and everybody's a little bit different, but I think it has very broad appeal.
Yeah, great. Well, so when you're kind of choosing, are you sticking more with individual stocks, or do you kind of go broader, as you said, with the sector rotations, or using kind of ETFs to kind of make those bets?
Yeah, for our ETF, I consider it like a fund of funds, or an
Right.
ETF of ETFs. So we are using sector ETFs for equity exposure,
Mhm.
and then we're using for risk management, other asset classes. So asset allocation into short-term treasuries, long-term treasuries, and gold, or ETFs representing those asset classes. For the research, we're imparting individual stock ideas quite a bit. We feel that's where we have a lot of interest.
Mhm.
And we can come up with themes as we analyze markets, and really infer not just the top down takeaways, but bottom up takeaways that can be really informational. So as much as we start top down, we start with those major indices, we drill into the sectors. The individual stock work is incredibly important to what we do. So we spend a lot of time week over week looking through individual stock charts, and that's why we'd have that chart space on our screen. And when we're looking at them, we are typically looking at the long term first, and then narrowing into the various time frames if that's relevant.
Mhm. Well, I'm going to throw up an Amazon chart here real quick. And again, this is a chart that comes from your research. And gosh, there's some familiar things on here. There's a stochastic oscillator, and there's a MACD. It looks like. Now there's a new thing there here. It looks like you have a 10-week moving average, a 40-week moving average, but there's this weird cloud that's hanging out.
That's right. It is the cloud,
The
the
cloud.
cloud
Okay,
model.
perfect. Well, I mean, Amazon has its AWS service, so I guess it's appropriate.
Yeah, that's a good point. It has a Japanese name that's something like Ichimoku. And the Ichimoku cloud is really valuable to us in terms of discerning the primary trend but then also understanding right where there might be forward-looking support and resistance. And without getting too deep into the construction of the cloud, visually you can see that it's quite appealing. Amazon, of course, relative to the cloud, the price bars are higher than and the cloud is trending higher. So it's just a good reminder in this situation that Amazon is in a long-term uptrend. And then we'll hone in on our sort of shorter term metrics, right? Those stochastics that you cited, the MACD indicator, perhaps also the slope of the moving averages. We're also taking all of that within context of where there's key levels on the chart. So in this case, there's a long-term resistance level for Amazon. It's around 189, I believe. And you can see it's been tested more than a couple times. Unsuccessfully, meaning we didn't see Amazon get above that level. So for whatever reason, the charts won't give you this answer, but hopefully it'll make sense from a fundamental perspective. People are stepping in and selling Amazon at that level. We don't know why, but it's good information to have. It's good information in that if we do see Amazon's sort of resistance level cleared, well, that's a breakout, and that tends to be a bullish development. We'd want to see it, as mentioned, for the major indices. We'd want to see it get up there and hold up there for a week or two. Otherwise, we can say risk might be heightened up here because it has been a well-tested level, making it harder to clear. And then you can reconcile that with the weakened momentum that's manifested itself in the MACD and say, you know what, with Amazon right at resistance, with weakened momentum, I think there's risk that the April pullback was the beginning of something a little bit more significant in terms of a corrective phase. So that's our takeaway here for Amazon. And of course, Amazon's a mega cap. It's a big contributor to the market cap and the major indices. So that we generally want to see these stocks going higher because it makes for an easier path for the major indices. So for right now, the message would be not to sell short Amazon, but to hold off on new purchases, maybe manage risk, whether from a top-down perspective or through perhaps some option strategy of a shorter term corrective phase.
You mentioned sector rotation. Do you ever kind of look at, the mega cap versus the small cap, what's in favor there? And especially given the Magnificent Seven talk back in 2023, was there something that kind of made you think, oh, the market indexes weren't necessarily showing the strength of some of those individual stocks? Or I guess I should have said it the other way. The market indexes were showing the strength of the Magnificent Seven, but not the weakness elsewhere.
That's right. So the breadth, we call that. Yeah. Well, it is important. It emphasizes the need to have that bottom up feel for the market. And we can get that through breadth measures, things like the cumulative advanced decline line for NYSE securities, the percentage of stocks above their 50-day moving averages or 200-day moving averages. There are some breadth metrics that help us understand what is the participation for these uptrends that we've got in place right now. And breadth started expanding really notably in Q4 of 2023, but it was lacking for much of the year otherwise. So, and now we have a very constructive environment from a breadth perspective. That tells us that the uptrend is probably just taking a pause in here as opposed to reversing. And it does make for more opportunity from a bottom-up perspective, meaning that we're not limited to those Mag 7 stocks for opportunity. You don't have to necessarily be an NVIDIA to succeed. It's a good case in point.
Great. And you know what? Let's go ahead and go back to the Amazon chart real quick, because I want to ask you one more question here. When you're looking at different stocks and you're looking at, okay, well, gosh, this is an uptrend. This isn't an uptrend. What kind of guides you in terms of, if you're seeing a lot of stocks, again, as our breadth has gotten better, which one do you go for? If a lot of them are in uptrends, do you have any like relative strength measures that you use, or how do you make those decisions?
Yeah, I mean, relative strength is definitely a big input for us. We're often looking at it from sort of the sector versus the broader market perspective, or perhaps a group versus a sector. a stock versus a sector. And that is a way to discover opportunities. We can use ratios to do that. We can use something called relative rotation graphs to do that. But oftentimes we're scanning the charts for what we call technical catalysts, right? So these are different than headlines that we're seeking from an earnings report or something of that nature. But we want to see those MACD crossovers. We want to see stochastic upturns or downturns from oversold or overbought territory. We want to also see breakouts or breakdowns. So we're always looking for these catalysts, because it's those catalysts that give you an impetus to either reduce or add exposure, because they often see follow through. So we're always looking for technical catalysts, but there's also nothing wrong with just generally staying on the right side of an existing trend. And then it becomes more of like a risk management input to decide, well, okay, so NVIDIA, Amazon, they may look poised to pull back, but how much does that matter to me in my positioning? And that it goes from being a technical decision to ones that's more portfolio management related, because you need to take that position within the scope of your broader portfolio. And, there's tax implications and things of that nature that are really not a technical force. But certainly the charts can at least help us know whether we want to manage risk in certain environments.
Mm-hmm. Well, that's great. I think this is a good place for us to take another break. And when we come back, we can talk about a few more stocks that are on Katie's radar and what she's looking at for them. Stay tuned. We'll be right back. Welcome back to the Investing with IWIBD podcast. Just Nielsen here, and of course, Katie Stockton from Fairlead Strategies. So, Katie, before we kind of get into some of the charts here on some of your individual stocks, I know that you have a lot of appearances on CNBC and elsewhere. Where's the best place for people to kind of follow your thinking and what you're looking at?
Yeah, we have the research product as mentioned, and I would encourage folks to sign up for a trial. We offer free trials through our website, fairleadstrategies.com. We also post most of our media appearances there.
Yeah, perfect. And then, of course, you're also on X, formerly known as Twitter, and that's at Stockton Katie. Is that right?
That's right. Yeah, and we have a Substack newsletter as well.
Okay, perfect. So lots of great stuff there. And I should also mention that the fact that your ETF is called Fairlead Tactical Sector ETF. I love that you have the ticker symbol TACK. I always love when tickers go with kind of the theme. And to that end, let's go ahead and take a look at one of the first equities that you've got on your radar. This is Moo, which of course is in the agriculture business space. So another great ticker. And what is it that is exciting you about Moo? Because normally in such a technology-based market and all of these, CrowdStrike and software security, AI, Moo, agriculture.
I know. And this is us adapting to the market, right? We have to respond to what we're seeing. And I think when you see this chart on the surface, that the takeaway would be that this is a downtrend. Not only is it something that maybe doesn't have the same general interests as a large cap technology stock might, it is a downtrending ETF. But within the downtrend, we've seen a pretty meaningful loss of downside momentum. And we're interested in things right now that are a little lesser correlated to the S&P 500, with the thought that the S&P 500 is prone to a pullback. Mm-hmm. So we want to find things that are actionable right now. And there is always that, right? There's always something in some asset class somewhere in the world, right, that is providing opportunity. So sometimes we call it getting creative when we're looking for something that's a little bit different and might create some opportunity in its differences. So that's Moo. This is the agribusiness ETF. You can see that the downtrend has given way to a successful test of long-term support, meaning that it came down. It's made a very sort of slight higher low. And with that higher low, you can see how momentum has improved in the backdrop based on that MACD indicator, making higher lows. And also we have a nice upturn in the weekly stochastics pictured. So all of that taken together suggests that this is a basing phase for the MU ETF. And we can reconcile that with our views on commodities that might be beneficial to these players in this space. So we have downtrends that seem to be culminating in things like soybeans and corn and wheat. And that's another intriguing enhancement, I would say, to the potential here for a bigger counter trend move, where the MU ETF goes from a downtrend to an uptrend is where that cloud-based resistance area is cleared. So that'll probably take some time. It is a thick cloud, and therein might be harder to clear. But listen, even a move up into the cloud would be significant enough as a trade.
Yeah. So to be clear, this is something that you're just kind of preparing for, kind of if this happens, then we're going to do this. You're certainly looking for that break of the downtrend and that kind of evidence of strength, right?
Yeah, and I mean, we are comfortable adding exposure in line. We feel that we always want to make sure that our ideas are actionable in the moment. But where it would go from, let's say, a counter trend position to something that might have more longevity is indeed above that cloud-based resistance.
Okay, very good. Now, another one that, I guess this is in preparation, for maybe a weaker market. You usually think of General Mills as more of your consumer staples, and, when those are outperforming a little bit more on the defensive side. So talk a little bit about General Mills, why this is kind of on your radar.
That's right. It again, maybe not the most exciting idea to some people. And when we looked it up as it pertains to its beta, so the relationship to the market from a volatility perspective, it was extremely low beta, like lower beta than most other stocks in the space even. So that's intriguing in a way, because it does suggest that in a down market that it should do better. It should be safer in that environment. So it's not to say we're really bearish on the equity market, but because we're expecting a pullback, again, we're looking for things that might do better in that environment and to act differently. And indeed, General Mills has already acted differently. It's a turnaround story from a technical perspective. You can see even in the curvature of the 10-week moving average, which is sort of a replication of the 50-day moving average. It's gone from downtrending for much of 2023 to now uptrending. So we like to see that shift. And that reflects the shift in intermediate term momentum as well in the MACD. And it's still short of overbought territory. So we don't feel like we have this extreme move from General Mills that makes it higher risk. And there's also a good deal of room to resistance on the chart as well, meaning that the previous peaks and troughs in the upper boundary of that cloud, it's 74, 75, and that's, a good amount of room from current levels.
So are you kind of looking at these as short-term plays, like places to kind of park money temporarily while the market goes through its pullback?
Yeah, so it depends, right? Every idea starts out as sort of short to intermediate term for us, but with long-term hope and prospects, right? We, listen to the market, and if the market changes, we'll change with it. We want to generally just stay on the right side of it, and we feel that these two are good examples of where we would be comfortable right now. But listen, the time frame can be different for everyone. So we. Our version of short term would be something like days to weeks, maybe centering around 3 weeks or so. Our intermediate term biases are usually centering around 3 months, so maybe about a quarter in duration. And then the longer term biases, of course, are 6 months plus. So our hope is to find ideas that have that longer term, sort of positioning and prospect. It's not always a market that lends itself well to that, but that's our goal, is to find these long-term ideas. But they all start, of course, in our work as short to intermediate term, because we want them to work right away. We don't want to have to wait for them to work.
Now, one more thing, you talked a little bit about the beta and how if the market's, again, a great place to park money is in the lower beta stocks, because you might come down, but you're not going to come down as much. What about inverse? Do you ever, you mentioned counter trends. Do you ever go with things that kind of go opposite of the market?
Right. Well, it's a great way to get hedged. And
Hmm.
so we do an ETF navigator report. And in that report, we have maybe 60 ETFs that we're evaluating every week. And it includes one side dedicated to what we consider to be hedging ETFs.
Hmm.
It is a question we get a lot. Well, okay, Katie, so you think, we could go down 5% or whatever it may be. I want to manage risk through that environment. What's a good way to do that? The VIX products, so the VIX being inversely related to the S&P 500, are
Hmm.
one option. They are very difficult to trade and to time. You have to really kind of be there for that spike and be ready, right,
Yeah.
to kind of reverse course quickly. So that's hard for a lot of us. So that's one option. And then, of course, there's inverse ETFs that will give you that inverse exposure to the major indices. I mean, there's so many products out there that will give you that inverse exposure. And we do feel like they're a very viable way to manage risk during just short-term drawdowns. So we don't want to own these inverse ETFs personally for the long term.
Hmm.
But during environments where we don't really feel like it's important enough to reposition from a bottom-up perspective, but we would love to see our drawdown limited. You can certainly use those inverse ETFs to that end and sort of just bide some time there, and it'll minimize your drawdown when you see that corrective phase unfold. So we're completely on board with that. I just watched the fees involved. We're also, of course, on board with employing asset allocation as we do in our own ETF. Our own ETF is not designed to move around during these corrective phases, but rather the bigger shifts. We're trying to avoid the big drawdowns like 2008 with our positioning.
Yeah.
Yeah, that to us is where you can really add value longer term in your portfolio. But if for those that want to manage the risk during the corrective phases, I think the inverse products are great.
Hmm. And then do you kind of go a little bit more on that hedging side? Again, kind of what you were talking about. Is this with like an extended market when you get really into that overbought area, or more of when the turn or when the correction kind of takes hold a little bit more? Where's the
Yeah,
ideal part for you?
those DeMark indicators that we started our conversation with can get us to a place where we are managing risk when the market's still pretty overbought. And, we do like to see a little bit of confirmation from the tighter momentum gauges, right? We may not wait necessarily for a breach of the 50-day moving average is one example that a lot of people tend to use, but rather say, okay, well, we have this overbought reading. If we were just to see a smaller downtick, perhaps on the daily bar chart, we might respond to that. So we do wait for confirmation, but we're not really stringent to, wait for the breakdown per se, or to wait for such a huge loss of momentum that we run a greater risk, I think, of missing the move or missing the opportunity to navigate that move. So I call it market timing. Some people think that's a negative connotation, but I actually think it's quite helpful,
Hmm.
to try to navigate these swings. And so we try to get there as close to the peak as possible, but still having the confirmation from the shorter term momentum gauges.
Great. Well, Katie, it was a real pleasure having you on the show. I'm glad I kind of got you all to myself. So we'll definitely have you on again with both Arusha and I. But
That'd be great, Justin. Thank you.
thanks a lot for being here.
Of
And
course.
again, folks can get your information at fairleadstrategies.com, see your media appearances, and of course, catch you often on CNBC. And of course, the ETF is TACK is the ticker symbol there. So thanks again, Katie.
Thank you. Take care.
Okay. That's going to wrap it up for us this week. Thank you so much for joining us. And do join us next week because we've got Jim Ropel coming back on the show of the Ropel Report and Ropel Capital Management. So do check in with us there. We're going to get his thoughts on the market, some of the stocks that he's looking at. And it's always a good time. He's a fun one. So hope you join us for that. Thanks a lot for watching. We'll see you next time.